Money FM 89.3, the best of the afternoon update.
Money FM 89.3. How are you doing this Monday afternoon? Welcome to Industry Insights, the segment where we unpack the latest trends shaping business, investment and opportunities. Now, today we're looking at an interesting development in the commercial property sector, a confident rebound in commercial real estate investment across Asia-Pacific. Now, according to new data from JLL, Q1 2025 saw a 20% year-on-year increase in commercial real estate investments totaling $36.3 billion US dollars. So what's fueling the rebound? Where's the money flowing? And how are investors navigating risk in this new cycle? Joining us is Pamela Ambler, Head of Investor Intelligence at JLL Asia-Pacific. Pamela, welcome.
Thanks for having me.
Great to have you with us today. Now, Pamela, let's start with the top line. A 20% jump in CRE investment is pretty significant. What macro forces or on-the-ground trends are fueling this rebound?
Yeah, I would say Q1, we're looking at comparing this number to Q1 a year ago. So if we think about where we were in 2024, the transaction volume was roughly 30 million as opposed to 36 million. So it does look like it's higher. At the beginning of the year, Q1, we generally do see a bit of an uptick. That's because if you're thinking about the trajectory of where rates were going, and rates meaning both the direction that the Fed has been giving us as well as the sort of cues Asia-Pacific central banks have been taking. These are all tending to trend lower. And keeping in mind, this is Q1 figures, so we're looking at January, February, March. A lot of this is collecting data and sentiment that came in before the latest Trump announcements on tariffs, which of course has provided some uncertainty to the picture going forward.
I see. So would you say it's a combination of improving macro conditions and investors making more deliberate data-backed decisions?
Well, absolutely. When we're looking at Asia Pacific, a lot of the fundamentals for the mature markets, for assets that are well located, they're still very strong. We're seeing rental growth, we're seeing capital value, as well as the metrics that commercial real estate investors look at, which is the compression of cap rates. Those can be found in select markets, and those markets include Japan, Korea, and Australia, the three that are the most dominating in terms of attracting global capital. And when we talk about global capital, it's not just the obviously interregional capital, but also capital from Europe, from the U.S. as well. And another thing I'd like to point out is the fact that the more diversification play is more so on investors' radars than ever before.
Okay, let's break this down by sector. Most sectors saw growth, but the biggest surprise for many was that industrial and logistics, the star of the last few years, actually saw a dip. So what's going on there?
Yeah, the dip was marginal. We do have to show that our data shows that South Korea actually was a bright spot. So I'll start with that. It attracted the most amount of foreign capital. So Korea is a market where it's usually more dominated by domestic investors. But the fact that we're seeing foreign investors going in, making acquisitions, speaks to the confidence that they have for industrial and logistics for that particular market. For some of the other markets where we're seeing a slight pullback, it's also a result of our data is comparing Q1 to a year ago. There could have been large portfolio transactions that had taken place in Q1 of 2024. But overall speaking, industrial and logistics are still maintaining a very healthy level of transaction activity.
So it's less of a slowdown, more a recalibration of sorts.
That would be a good way to characterize it. Yeah, absolutely.
Okay. What about office? Office seems to be making a comeback too, despite the persistent remote work narrative. So what's changed?
Office was up 31% year over year. So that's a very strong conviction. When you're looking at, again, I mentioned the markets that are attracting a lot of the capital. Japan and South Korea, they accounted for more than 75% of the Q1 volume. And that's because we're seeing the so-called mega deals beginning and continuing, I should say, to transact in that marketplace. So when you mention the return to office concern, other than Australia and Asia-Pacific, that's not really a big problem for most markets. When you look at the market dynamics for markets in APAC, you're looking more at the supply and demand balance. So as long as the net absorption, which is a proxy for how we track demand, as long as the net absorption is still positive, it speaks to the fact that we can see more rental growth in the future. And also, as long as supply is managed in a manner in terms of the pipeline. And why we know that supply, to a certain extent, most markets are well managed, is because even when we have the delays that have built up during the COVID years, we also have now higher construction costs than what existed before because of inflation. That inflation overall is beginning to come down in most markets in Asia-Pacific. But when you think about the material costs, and that could be more of a global material cost benchmark, that's still elevated.
Oh, interesting. Now, let's take a look at retail and living sectors. These seem to be re-entering the conversation. Are those defensive plays or a sign of structural rebalancing?
Yeah, that's a great question, because retail is one where we're seeing a lot, not just in APAC, but globally, investors beginning to move back into that space, because retail has been repriced so much. Even before the COVID pandemic, there has been a repricing and probably overexposure to some extent. And so the rents have come down, the capital values have come down, and so it's become very interesting for an investors from a pricing standpoint to enter and pick up retail assets. And added to that, the supply side of things, there has been less on the planning and pipeline side for building retail assets. There have been probably some conversions or mixed use developments, but when we're talking about pure play retail, that pipeline is a bit limited, and therefore it's interesting for investors to look at that asset class as a whole.
What about things like student housing or senior living in terms of living sectors?
Yeah, student housing is where, when you look at the demographic dynamics, it makes a whole lot of sense. Because enrollment in Australia in particular, but also for other markets, you do see student enrollment continue to pick up. And so with the fact that you have a pickup in the amount of students needing housing, for a lot of the markets, there has been a limitation on how much government or universities have been able to provide. And that overspill of students have been looking at basically multifamily or living in just normal, built to sell or built to rent type facilities. So you're now looking at addressing a very specific demographic where you can get pricing a lot more accurate in terms of their demands and their needs. And so in Australia, you are seeing a few purpose-built student accommodations being transacted, where anytime there is such assets listed, the demand is very strong. And when I say demand, this is on the investor side, the number of bidders that are expressing their interest in acquiring these type of assets. And they're beginning to specifically look for student accommodation.
Okay. Pamela, moving on, let's talk about how investors are thinking now. Are we seeing more creativity in capital stacks or partnerships? What's changed in the decision-making process, or has anything changed at all?
Yeah, private equity groups have been very active, and the way they have been going about gaining entry, especially into new markets, is looking at mergers and acquisitions. So mergers being a platform deal where they would perhaps purchase an operating platform that has assets underneath it, or taking a publicly listed company and taking it private. This was particularly prominent over the last couple of quarters, and we do continue to see that being the case, because there is a lot of, if an asset is on an investor's or on a company's balance sheet, they might not be marked to market, and they might be undervalued, if you will, compared to ones that are not a part of somebody's existing portfolio.
Okay, so are you seeing a noticeable shift in how data is being used in decision making?
Oh, absolutely. I mean, data is the basis and fundamental around, I think, all decision making, so especially at times where there's uncertainty, people lean even more towards the data to support investment decisions because you're going to have to make a financial model work in a different way. You have to scrutinize further with more data points just to stress test it and create scenarios that is the best case scenario, the worst case scenario. And in order to do that, it all requires more granular level data and data on a sub-market basis.
Such as perhaps ESG scores?
ESG scores, I would say probably I would consider that a little bit more independent of most of the, at the end of the day, returns obviously plays probably the primary role. And depending on the type of investors, their goals and objectives are different, right? When you're talking about a pension fund, they're probably looking for something that's more stable, income generating. You have investors that are willing to take more of a risk for a higher IRR. So it really depends. And there are, of course, a lot of funds that were raised in the so-called value add and opportunistic camp over the last year or so. And they're probably looking for deployment opportunities where they're looking at assets that need to be repositioned, where they have to put in that CapEx.
Okay, but in terms of what we were talking about earlier about, investors focusing on more data-driven decisions, it sounds like we're moving from location to data.
That's very interesting. Yeah, I would say data has always played an integral role, and now so more than ever. And the sort of data points they're looking at have expanded to also metrics beyond just the physical and financial indicators, but also a lot more to the macro side of things as well.
Okay. Speaking of which, let's talk about external headwinds, geopolitics, currency volatility.
Currency volatility, I think that certainly is one of consideration. The interesting thing about a lot of the funds and investors that we deal with, so there's different approaches. One is certainly ones that take into consideration for their treasury team a hedging strategy, but then a lot of times there are funds that are specifically raised for, say, a particular market. Once that money is deployed into that market, they would be recycling capital and keeping it within that particular market, therefore eliminating that currency volatility. When it comes to, I think, the direction, just generally speaking, we know that the Chinese yuan is probably going to be facing a bit of depreciating pressure ahead, whereas the Japanese yen is probably going to feel a bit more on the side of marginal appreciation given the weakness in the U.S. dollar.
Now, speaking of Japan, in your research, the Q1 2025 research, Japan topped the list in Q1. Why is that?
Well, Japan always is the most liquid market in Asia-Pacific amongst the major markets, but the fundamentals, as I mentioned, are still there. So when you look at the healthy amount of inflation that exists, where Japan has maintained roughly between that 2 to 3% level of inflation, it is beginning to come through to the real estate side where you can command rental growth. In addition to sort of the traditional sectors of office, logistics, and retail, Japan also has a larger, more mature multifamily sector for the deployment of living. So the living volume probably also helped lift Japan's transactions overall, particularly seeing that there were a few portfolios that were transacted.
And looking at Singapore, the data that you've got here, Singapore also held strong. Is that a fundamental story or more about capital safety?
Yeah, Singapore has always been quite stable. It's considered a safe haven market, has been, and especially during times of volatility, capital tends to gravitate towards safe haven market with a high level of transparency. But the downside of Singapore is the fact that pricing hasn't changed a whole lot. So it hasn't come down, which makes it expensive, relatively speaking, compared to the other markets. And so the investors that are looking at Singapore They, of course, are aware of the geopolitical headwinds, and they are looking for higher yielding income-generating assets. And leasing risk is more of a focus, making sure those are tenants with good credits and plan to stay without giving back space.
Pamela, we've run out of time, but before we let you go, your one-sentence message to investors eyeing Asia-Pacific CRE right now.
One message. Well, we named our report this for the spring without fear or favor. And I think that's a statement to say that when you look at real estate investors, it's very different from the equity markets. You got to just get rid of all of the noise and really go back to the basics, what you had said earlier about how data is important, looking at the historical data and being able to model a clearer future. That is what gives investors the most conviction when investing.
Okay, data, perhaps strategy, and lots of clarity. Thank you so much, Pamela, for joining us on Industry Insight. We appreciate your time as well as your fantastic insights today.
Thanks for having me.
Pamela Ambler, Head of Investor Intelligence at JLL Asia-Pacific.
To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.